Assalamualaikum and very good morning to Madam Sasilah binti Muhammad Ali and our beloved classmates. Today is our turn in presenting the tutorial question, which is tutorial question 5. Before starts, let me introduce our team members. The first one is Nurazlin binti Muhammad Azman, second Siti Hajar binti Ahmad Nizam, third Nurul Syafiqah binti Khalil, and myself Nur Anisha Izayu binti Razi. Here, we show you guys our question, which is question 5. Some argue that development of a conceptual framework is inappropriate because accountants constantly deal with specific issue that will not be envisaged by an overall general conceptual framework. In particular, the accounting conceptual framework makes no allowance for differences in the social context where accounting is applied. They also argue that it will be preferable to develop case-specific solutions to accounting issues based on case study research. And bearing in mind in the social context of all accounting decisions required, select one of the following topics and discuss in a 40-minute presentation whether the conceptual framework is helpful in solving them. First, accounting for Islamic financial instrument. Second, accounting for agriculture. And lastly, accounting for property development. And our group will choose accounting for property development. Before we discuss more further regarding whether conceptual framework is helpful in accounting for property development, let me briefly show you guys a little bit about conceptual framework. So let's start with the background of the development of the conceptual framework. So, the accounting profession in the US became interested in accounting theory following the collapse of the US stock market in 1929. Many companies failed and large sums of money were lost by investors. Accounting also was assigned some blame for this crash. Critics argue the contemporary accounting practice such as asset revaluation led to misleading financial statements. This, in turn, led to unreasonable optimism which inflated share price, worsening the stock market crash. In response to the criticism, the US accounting profession sponsored a number of studies to codify accounting principles, increase consistency, and also to reduce TYCT. Since the early effort to develop a conceptual framework or theory of accounting, there have been a continuing interest in the development of a framework to underpin accounting practice and to form the basis for setting new and reviewing all accounting standards. The first accounting standard setting body was established in 1936 when the American Institute of Accounting, since renamed the American Institute of Certified Public Accounting, formed a committee on accounting procedure which published accounting research and terminology bulletins that provide opinion or recommendation on accounting practice. Although the bulletins provide recommended solution to particular financial reporting problem, they did not result in a comprehensive statement of accounting principle. This failure on the part of the committees was criticized. The committee was also criticized for working too slowly and for refusing to take unpopular position on controversial financial reporting issues. In 1959, AICPA recognized and established the Accounting Principle Board (APB) and an Accounting Research DVD (ARD). The objective of this organization were to first set up basic accounting postulates, second, establish a set of broad principles, third, formulate rules to guide the application of principles in specific situations, and lastly, base the entire program on research. And in 1970, the US accounting profession's first conceptual framework was created. It was based on the codification of the existing practice. In 1973, following the criticism of the APB's work, the APBs were replaced by the Financial Accounting Standard Board (FASB), which was independent of the accounting profession. The FASB objective is on the development of a new conceptual framework for financial reporting, which has resulted in the publication of 6 statements of financial accounting concept. Start in 1987 until 2000, the FASB issued 7 concept statements covering topics such as objective of financial reporting, qualitative characteristic, element of financial statement, recognition, and also measuring criteria. And in 1989, based on the FAB's concept statement, the International Accounting Standard Committees (AIIC) issued the framework for the preparation and presentation of financial statements. Starting from 2001 until current year, the International Accounting Standard Board (IASB) replaced IASC and adopted the framework. The framework served as a guide to the IASB in the development of accounting standards and also theories of accounting issues. Now, let's move to the objective of financial reporting under conceptual framework. The objective of general purpose financial reporting is to provide financial information about the reporting entities that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. Those decisions involve decisions about buying, selling, or holding equity and debt instruments, providing or settling loans and other forms of credit, exercising right to vote on or otherwise influence management action that affect the use of the entity's economic resources. Now, let's identify the importance of the conceptual framework. First, conceptual framework help a better understanding of accounting information. For example, general purpose financial reporting and intern their confidence in IFRS. Furthermore, conceptual framework promote harmonization by giving a basis for selecting the most appropriate accounting treatment permitted by financial accounting standards. It also assists in dealing with events, transactions, conditions, or circumstances and does not deal with any financial accounting standard developed by AAOIFI. This framework helps users of financial report in understanding the information enclosed in the financial statement prepared in conformity with financial accounting standard. Second, conceptual framework also direct the development of future financial accounting standard and regulator of subjective judgment made by management while preparing the financial statement and other financial report. It will help national standard set bodies in increasing national accounting standard. In addition, it gives those who are interested in the work of AAOIFI with information about its approach to formulating the financial accounting standard. Janet Blanhead says the conceptual framework is absolutely an important document for the board as well as constituent. He believes in the primary use of the framework is to make sure that the FASB does not issue standard in the random fashion. The framework provides a necessary common conceptual underpinning that help the board resolve the issues. Third, it will provide the risk capital to the investor and the advisor is concerned with the risk inherent from their investment. The information is needed to help them to determine whether they should sell, buy, or hold the shares. Information which enables access to the ability of the enterprise to pay dividends is interesting to the shareholders. Employees and also their representative groups are also interested in the stability and profitability of their employees and the information that enables them to assess the ability of the company to give retirement benefits, employment opportunities, and also remuneration. Now, let's move to the limitation of conceptual framework. The first one, it will be difficult to set up. One of the main weaknesses is it is very tough to set up. The other factor which can be seen as the restriction of the conceptual framework of accounting are time consuming. Developing countries may not be able to afford to create a conceptual framework of accounting. Second one, it may lead to rigidity. Conceptual frameworks, while providing the standard for accounting practice, may lead to rigidity. It may be difficult to bring forward new ideas. Some features of conceptual framework may not provide much guidance to accounting. The concept of conceptual framework is rigid and encouraging incorporating new ideas is too difficult. Third, it may not be acceptable to every party. Conceptual framework may not be acceptable to every party. It may only benefit only some interested group identified as users. The framework also cannot be workable or acceptable to all parties. And lastly, conflict may arise between conceptual framework and accounting standard. Conflict may arise between conceptual framework and accounting standard follow the prior to the introduction of conceptual framework. Other prior established standards sometimes differ from the basic principle of conceptual framework.
The topic that we choose is accounting for property development. Before we move further, let's look at the definition first. Property development is the activities involving the necessary steps to plan and construct, and comply with statutory and contractual requirements in the development of land into vacant lots, residential, commercial and/or industrial buildings. Property development, also called real estate development, is the process of developing buildings or land into a higher use value. Next, the nature for property development. The nature of property development is a specialized industry, and a separate standard will improve the quality and comparability of financial statements prepared by entities engaged in such activities. A property development entity may perform all or the majority of property development activities in-house, such as planning, design, and construction. Moreover, industrial, commercial, and residential developments may all be developed by property development entities. A major feature for property development operations are spread out over more than one accounting period, because the procedures involve gaining approval from appropriate authorities and the construction work itself. The nature of the development activities is such that the revenue may be received at varying points in time and quantity. Sales of development units can occur at any point during the construction process, including when the project is first launched, while other sales may be made after the project is completed. Also come with various forms of incentive. Property development costs are also specific to this business, necessitating a separate cost allocation mechanism for common infrastructure and associated costs across a life cycle that is generally longer than the costing system used for a building phase. It is vital to consider how much land should be classed and measured. Even if a big piece of land is to be developed in stages, common infrastructure may need to be built for the entire area rather than just the portion that is presently being developed. There are two objectives. Firstly, to prescribe the accounting treatment for revenue and costs associated with property development activities. The issue related to this is the allocation of property development revenue and costs to the accounting periods in which the property development activities are performed. Secondly, use the recognition criteria established in the MASB's proposed frameworks for the preparation and presentation of financial statements to determine when revenue and related expense and hence profit from property development activities shall be recognized in the income statement. The issue related to this is the classification of land held for future development by property development entities. Next, moving on to the scope. These standards shall be used in the financial statements of the business engaged in property development operations to account for property development activities. This standard also replaced MASB approved accounting standards MAS7 accounting for property development. This standard applies to entities involved in property development activities, including those subject to the Housing Development Act 1966, whether or not such operations are their main activity. Property development in these standards refer to the business of acquiring land for purpose of construction and sales of completed residential, commercial and/or industrial structures, whether as a whole or in lots, and development and sales of vacant properties for the purpose of constructing structures such as homesteads, hobby farms, orchards, or other similar use. Next, there are 5 elements in a property development, which are land held for property development activities, property development costs, property development revenue and expenses, estimates revocation of sales and incentive, inventories, also completed development units. The first element is land held for property development. Land held for property development shall be classified as non-current assets where no development activities have been carried out or where development activities are not expected to be completed within the normal operating cycle. Land held for sale shall be carried at a cost less any accumulated impairment losses. Any entity shall apply FRS 136 impairment of assets to determine whether the land has become impaired. The change in the classification of land held for property development to current asset shall be at the point when development activities have commenced and where it can be demonstrated that the development activities can be completed within the normal operating cycle. Current assets as defined by FAR661 presentations of financial statements are assets that are expected to be sold or consumed during the regular operating cycle. Next, I will pass to Siti Hajar to explain regarding the other elements in the property development.
Assalamualaikum warahmatullahi wabarakatuh. My name is Siti Hajar Izam. Thank you Syafiqah for the presentation. I will continue the presentation for element 2, 3, 4 and 5. Second is property development cost that shall comprise all costs that are directly attributable to development activities or that can be allocated on a reasonable basis to such activities. The costs that relate for property development activities can be categorized into first costs associated with the acquisition of land. These costs included the purchase price of land, commission, stamp duties, promotional fees, conversion fees, and other revenue levies. B. Costs related directly to a specific property development activity. These costs include professional fees and infrastructure work that are related to the project and collector costs for the building works. C. Costs attributable to the development activities in general and can be allocated to the project. Contingency costs that relate to defect liability are included in costs attributable to the development activities. The cost that may be allocated to property development activities is A. Cost that would be allocated to existing and future property development project within the same geographical location related, such as common infrastructure costs. B. Costs that would be allocated to a project currently in progress in various locations unrelated. For example, the entity undertakes certain corporate expenditure that relate to existing property development project. Next, the third element is property development revenue and expenses. For the revenue, it shall comprise A. The selling price agreed in the sale and purchase agreement, and B. Any additional revenue due to a variation in development work. A variation is a request from the client to alter the scope of work to be performed under the development project contract of sale and purchase agreement. The example is changes in the duration of the development project contract and changes in the specification or design of the asset. The following are all the criteria when revenue recognition commences, which are A. When the sale of the development unit is effected. As example, upon the signing of the individual sale and purchase agreement. B. Upon the commencement of development and construction activities. And C. When the financial outcome of the development activity can be reliably estimated. While for the expense, the attributable portion of property development cost will be recognized as expense when property development units are sold in the period in which the related revenue is recognized. The attributable portion of property development cost is recognized as expense, resulting in the matching of expenses and revenues. An entity must use the technique that this reflects in circumstance for determining the allocation amount or portion. In addition, when the outcome of development activity can be estimated reliably, property development revenue and expenses shall be recognized in the income statement. Next, estimate the proportion of sale and incentives. Estimate shall be reviewed at the end of each financial reporting period until the project is substantially completed. On the basis of current estimates, costs will be adjusted and reallocated as needed for any modifications. As a result of inconsistencies inherent in property development activities, cost and revenue estimate cannot be measured with precision. Reasonable estimation are necessary in the preparation of financial statement and do not undermine their accuracy. When decision or revocation of sale occurred, project development revenue and expenses recognized shall be immediately returned back as soon as possible. In order to entice buyers, property development companies frequently offer incentives. The incentives could include a developer guaranteed occupancy of the development units or guaranteed return on the purchases investment for a specified period. The incentive or promotional costs incurred by the property development firm in connection with the sale of its development units must be recognized in the income statement rather than capitalized. Similar to administrative and maintenance fees, converted deposit and interest receivable. Lastly, inventories of unsold completed development units. These inventories shall be stated at the lower of cost and net realizable value and accounted according to the FAR661 Property Plant and Equipment (PPE) or FAR6 140 Investment Property. That's all from me. I will pass to the next presenter, Azim, to continue the presentation.
Assalamualaikum and hi. I am Nur Azrin Muhammad Azman and I will discuss further to answer the question on whether the conceptual framework is helpful or not in solving these problems regarding the accounting for property development. In order to see whether it is helpful or not, we will discuss it in terms of MFRS and MPERS because those standards were developed by MASB using the conceptual framework as a reference. Firstly, is the definition of MFRS and MPERS. MFRS is the Malaysian Financial Reporting Standards, which is the authorized accounting standards for entities by MASB. However, private entities are not included. It is mandatory for non-private entities except for transitional entities. It is also commonly used and performed by business with a holding company which must generate group consolidated accounts. Companies preparing an initial public offering would profit the most from the MFRS. Following Malaysia's governance exercise, this framework complies fully with the IFRS set by the IASB. For MPERS, this is the Malaysian Private Entity Reporting Standards, which is the approved accounting standard for all private organizations by MASB, which took effect on January 1st, 2016 and replaced the prior PERS. With the implementation of the new MPERS, private entities can now choose between the existing PERS framework or apply the MFRS in preparing their financial reports or mandatory migration to the new MPERS framework. MPERS is closely aligned with the IFRS for SMEs. Why both of these standards are helpful in solving issues related to the property development? For MFRS, it is because it serves as a guide in resolving specific property development issues. The issue involved is allocating property development revenue and costs to the accounting periods in which the property development activities are performed. In the MFRS, it stated that the revenue shall comprise the selling price agreed in the sale and purchase agreements, and also any additional revenue due to variation in development work. Meanwhile, for the costs, it shall comprise all costs that are directly attributable to development activities, or that can be allocated on a reasonable basis to such activities. The secondary issue is the categorization of land held for future development by property development entities. It shall be classified as a non-current asset where no development activities have been carried out or where development activities are not expected to be completed within the normal operating cycle. And the third issue is the inventory of unsold completed development units. The MFRS assists the business in determining that inventory should be reported at the lower of cost and net realizable value. For MPERS, it is helpful because it allows for greater flexibility in the choice of accounting policy when making property development decisions, allowing the business to select the best technique or policy that best meets their needs and circumstances. Furthermore, it has simplified presentation requirements such as the presentation of statement of income and retained earnings in place of statement of comprehensive income and statement of changes in equity. MPERS also has less rule-based requirements. A rule-based system in accounting is a list of detailed regulations that accountants should follow in order to create financial statements. This means that even if the companies made a mistake in their reporting, they can still dispute it out based on the conditions and circumstances. Both of these standards are also sometimes not helpful to solve issues related to property development. For MFRS, it is not helpful because there are uncertainties inherent in property development activities, which are uncontrollable and unpredictable. As a result, cost and revenue estimates cannot be measured accurately. The use of reasonable estimates is necessary for the preparation of financial statements and does not undermine their accuracy. Revisions to cost and revenue estimates due to property development activities in general will be allocated to both current and future projects as needed. Sequence of these inherent uncertainties, it may cause ideal policies to be less successful in terms of outcomes, intensity, or time of implementation. For MPERS, it is not helpful because the MASB has not released a new PERS standard, despite the fact that there have been major modifications and innovations and improvements to the MFRS in the previous 18 years, and the PERS standard has not been revised to accommodate these changes. There is thus an 18 years gap between PERS and the latest reporting framework. For private entities that continue to use PERS, the gap will only become wider in the future unless new PERS standards are issued and the existing PERS standards are regularly updated or improved. As a result, it may not correctly reflect all of the changes or improvements that occurred during the gap, and it may not resolve some difficulties or uncertainties concerning the property development. As a conclusion, when the companies depend on the MFRS and MPERS, which were developed by MASB, using the conceptual framework as a reference, they may find that the framework are sometimes helpful and might also be unhelpful to be used in handling accounting issues relating to the property development activities. Hence, the usage of the conceptual framework becomes inappropriate if organizations rely solely on it to cope with the issues. Therefore, the companies should construct their own property development framework based on their company's policy and procedure to follow with the circumstances and meet the requirements needed. As a consequence, the organization can forecast and revise any estimation or decision made in the face of unpredictable situations. The initial conceptual framework based on MFRS or MPERS can still be appropriate to be used just to assist and guide the business in developing their own revised framework, because the revised conceptual framework may help the financial statement preparers in developing accounting policies for transactions or events that are not covered by the current standards. According to Wutzbach and Miles, a property development process consists of 8 stages. This is the general process of property development. The process represents the real flow of operations during a development. It is not always exactly followed by other companies in real-time events, but it does provide a useful framework for analyzing the process of a property development. Meanwhile, Based on the case study of the Integrated Real Property Development Model in Hong Kong by Bo Sin Tang, they demonstrate their process of real property development, which is the simple combination of railway and real estate, which reflects the real process that actually occurred. Returning to the original question, the development of a conceptual framework is actually appropriate to be used, since it can be tailored to the company's strategy and policy. Besides, it is also preferable to develop case-specific solutions to accounting issues based on case study research and bearing in mind the social context of all accounting decisions, because it can assist accountants in resolving all uncertain occurrence or issues that happen during that period. That's all from us. Thank you.